Silver just shocked the markets again. Prices surged, pulled back, and many are screaming crash. But let me tell you, this isn't chaos, this is market structure in action, and if you're watching carefully, it tells a story few understand. In this video, I'm going to walk you through exactly what happened in the last 72 hours, why Asia is increasingly setting the tone, why physical demand is driving prices, and why this surge could be the start of a whole new silver bull market. So, pay attention, this is critical. Let's start with the numbers. In the past 3 days, silver jumped sharply, moving from the low 70s to around $76 to $78 per ounce on COMEX. That's a huge move in such a short period, and it explains why people are calling it a rocket. Now, during the London session, silver pulled back slightly. Some called it a crash, but here's the truth. This was a healthy technical correction, what traders call a gap-fill pullback. When a price moves violently upward, the market often retraces briefly to fill a temporary vacuum. Basically, a spot where no real trading happened before continuing higher. Here's what I noticed. The dip to 76 to 77 wasn't panic. It was precision accumulation. And here's the kicker, while COMEX shows these paper prices, physical silver in Asia, especially in Shanghai and Dubai, is trading at a premium, often significantly higher. That tells us that real-world demand is driving this market, not just speculative paper positions. This isn't a fake rally. This is grounded in physical scarcity and accumulation. This divergence is a huge signal. It means Asia is increasingly setting the market's tone, and the COMEX paper market is reacting secondarily. The days of paper-driven rallies are over. We're entering a market where real-world scarcity drives prices. Analyst Peter Grandich explains it perfectly. Physical demand now drives prices rather than paper trading, with Asia increasingly setting the tone. Tight supply, rising end-user demand, and a global scramble for critical minerals make this bull market very different from 2011. And here's what I see. When physical demand is this strong, short-term volatility doesn't matter as much. What matters is accumulation at key levels and watching how institutional players move. Now let's zoom out. What does this surge mean for 2026 and beyond? First, silver could continue rising toward $100 over time. Gold may approach $5,000, according to Grandich. Extreme prices above that would indicate serious global stress, but the current trend is bullish and structurally supported. Second, institutional timing is critical. Large players position quietly weeks before major resets, which explains the current sharp swings. Volatility right now isn't chaos. It's a pressure cycle designed to shake out weak hands and prepare the market for the next move. Third, supply constraints. Industrial demand, physical accumulation in Asia, and shrinking above-ground inventory mean that silver is scarcer than most people realize. Every pullback is an opportunity for accumulation, not a signal to panic. Now, here's my personal take. If you're watching silver, now is the time to understand the pressure points, see the divergence between paper and physical, and recognize the forces driving the next surge. Ignore the noise. Focus on structure. So, why did silver surge so dramatically? Multiple forces collided, and if you miss this, you'll misread the market. First, index rebalancing. Large commodity index funds adjust their silver holdings periodically. When they do, they create short-term selling, which can look like a crash to casual observers. But this is expected and temporary. Second, profit-taking. Silver has risen over 160% in the past 18 months. Some traders naturally booked profits, which contributed to the pullback. But this is normal. The key is what happens after. Third, institutional accumulation. Smart money had orders ready around $76 to $77. When the pullback hit, these players snapped up positions, pushing prices back up. That's why the recovery was so sharp. Fourth, macro and geopolitical factors. Interest rate expectations, industrial demand, and global uncertainty are driving safe haven buying. If you're following global events, you can see why silver, more than many other assets, reacts sharply in these conditions. Now, let me be clear, this isn't randomness. Sharp drops followed by fast rebounds are what traders call a false reset, a setup that usually precedes major directional moves. This pattern shows up repeatedly in metals markets. If you understand these cycles, you can see the next move before most people even realize it's happening. This is where it gets really important. Paper silver and physical silver are telling two different stories right now. COMEX futures fluctuate minute by minute. They can look scary, but physical silver, especially in Asia, tells a completely different story. In Shanghai and Dubai, buyers are paying a premium, sometimes double-digit above COMEX prices, because physical demand is strong and supply is tight. To summarize, silver surged, but this isn't random. It's backed by physical demand and market structure. Pullbacks are healthy corrections, not crashes. Physical versus paper divergence shows Asia is setting the tone, not COMEX traders. Institutional flows and pressure cycles suggest the next major move could be significant. But the story isn't over. Analysts warn about COMEX defaults, supply scarcity, and even $120 silver scenarios. That's what we'll explore in the next video. Breaking down COMEX, the paper versus physical market split, and how to read these signals before the market resets. So, if you want to understand why silver is surging now and what could happen next, make sure you're subscribed, hit the bell, and stay tuned. This is just the beginning of the silver story, and trust me,